Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So before we get started, I just want to quickly plug that there's going to be a live stream today exclusively for YouTube members at 6 p.m. Eastern. Today's March 30th, 2024. If you want to join and be part of the live stream, you simply click this join button right here. 99 cents a month. You get access to two things, loyalty badges and access to the live stream and the recording. So just want to plug that in before we get started. So in today's video, we're just going to do another quick velocity banking review and learn about or talk about using multiple credit cards, right? So in velocity banking, the goal is to pay off your debt using one line of credit as your main tool. Okay. And I have a situation here where we have three credit cards, but just because we pay off these credit cards does not mean we just never use them again. We can certainly use it. I'm going to show you how that works. But let's first go over the two requirements when it comes to doing velocity banking. Number one is the budget, which we have right here, income, expenses, and then when we do our expenses, we do an expense breakdown. And what's very important is that every single debt that we have must be its own line item. So think of this as a way to figure out how to how to patch leaks in our cash flow bucket. So everything that is a debt is essentially a leak in our cash flow bucket. And once we pay off the debt, that increases our cash flow, and we're going to use a line of credit as our main tool for that. So now let's figure out what the savings are, leftover savings for this person. So it's about $1,500, which is actually pretty good because most people are broke as a joke, right? Living paycheck to paycheck is the norm, especially with inflation. Now, if we have our debts paid off, that's going to be a huge relief for those who are dealing with, the size of their savings decreasing by inflation. And we're going to go ahead and do that using velocity banking. And so we assume two things, right? Same income, but no savings, right? And this is the part that trips people up. And I don't know about you, but I'm part of this group or this club called the No Savings Club. So if you ever seen any of my screenshots of my checking account, it's a big fat zero. Why? Because our entire paycheck when we do velocity banking goes into that line of credit, and that's the second requirement, a line of credit as our main operating account. Now, a credit card is a line of credit, right? A credit card is a line of credit, but it's a little bit different from a personal or home equity line of credit. A personal or a home equity line of credit is more flexible, right? So if I use that, I can pay anything, but I can't pay credit card one, or use credit card one to pay credit card two, and I can't use credit card one to pay off a mortgage, right? A little bit harder, maybe use plastic or balance transfer, but we're gonna have to do some extra steps. And so here's the thing: a lot of people are like, I can't get a personal or home equity line of credit. Um, you want to get as much tools as you can, right? So I don't know what it is, but a lot of people's like mindset is like I can only have one or the other, and I don't know why because I have over $258,000 in lines of credit, and most of those are credit cards. But I got a $50,000 home equity line of credit and a $15,000 personal line of credit, right? And so we have plenty of tools that we can use. And when I hear like, oh, I can only use credit card, that or a credit card, that's like someone like a repairman saying to me like I can only use a Phillips head screwdriver to screw in things and I can't use any other screwdriver, right? Get all the tools available that you need. And that's why it's important to know how to get credit before you ever need it, because there's a saying that banks only lend money to those who don't need it, right? So just make sure they want to make that clear. But let's assume because we have a home and we have equity, we can have access to something called a home equity line of credit, kind of like a credit card based on the value of your house. Okay, and the bank says, oh, okay, let's assume that it's a 10% interest rate and you have a $30,000 limit. $30,000, right? And let me go ahead and erase all this from previous demonstration. Okay, so now let's go ahead and use this as our main operating account. See, the only difference between the average American and the velocity banker is not the income, right? It's not the income because the income is assumed to be the same, but the difference is the main operating account, because here the main operating account is the checking account, and here it's the line of credit. All right, so now the actual strategy is paycheck into line of credit, expenses out, rinse and repeat over and over again. Okay, and so what we're gonna do is let's go ahead and pay off all these credit cards, three credit cards. We're still going to use them after we pay them off, but we're going to transfer this debt, and I'll show you how we would use them after they've been paid off initially. Okay, so that's going to be 22,000 of credit card debt. So let's just go ahead and move this right here. Okay, and now let's calculate our cash flow. So that's C2 minus C3. And here's the thing, because we transferred this debt, then guess what happens? Zero, zero, zero. And so we magically went from 1,500 to 2,200 in an instant without making more money, right? That's insane, right? So now let's go into the actual strategy. And actually, let me calculate how much debt we're going to pay off. So we have $22,000 in credit card debt, 205 in the mortgage, and so that's going to be 227K. So pay off 227K of debt. Okay, so we're going to pay all that off. All right. So now what we're going to do is the actual strategy is paycheck into line of credit, expenses out. Okay, but I want to highlight something, or not literally highlight, but I just want to call attention to this. So here's the thing: when you have credit cards, right? You actually want to use them, or else the bank is going to eventually close them, because if they don't see any activity, they're like, well, why are we lending you credit for? Because you're not helping us make money, right? And so just as long as you're using it, and again, I can't guarantee this, they're probably not going to close it, right? But the trick is you can still, using both a credit card and a line of credit, whether it's personal home equity, it's in your advantage to use both. Because think about this 1,500 expenses, don't take it out directly from the line of credit, take it out from the credit cards, right? So what's going to happen is if you use credit cards, you might get bonus reward points, but the main benefit is that you get to delay the interest by a month almost, because the advantage that a credit card has over a home or personal equity line of credit is that if you keep paying the balances in full, there's no interest. So what you can do when we're in debt payoff mode is that we pay off those credit cards just as long as they never go over 1,500. So what will happen is that these credit cards are going to be used here. You could distribute them equally or use one credit card at a time, 1 month, just as long as they never go over 1,500 a month. That's how you effectively use multiple credit cards while doing velocity banking. So if I go ahead and take out this 1,500 directly from the home equity line of credit, the moment I take it out, that's when interest is due, right? So what I would do is just use these three credit cards to pay my $1,500 in non-debt bills, and then when it's the very last possible moment to pay them, I'm going to pay them from the home equity line of credit while I'm in debt payoff mode. Now, when my home equity line of credit goes to zero, I could just use the credit cards. I don't need to use the home equity line of credit, right? But the way to effectively use multiple credit cards after you paid them off is just use them for your general expenses and never go above 1,500 a month in this example. Okay, so now let's go ahead and do this. Let's go ahead and calculate the average daily balance and all that. So the next month's balance. So the next month's balance is going to be this minus our cash flow. So to accurately estimate, it'd just be the previous month's balance plus the previous month's interest minus this cash flow number right here, 2270.92. So let's go put 2270.92, and then we're going to go ahead and calculate the interest. So let's go ahead and take the average of these two numbers, multiply it by 10%, right? 10% is right here. That's the interest rate. And then divide by 12 because it's when we get the monthly interest. And then we just go ahead and copy and paste these formulas, right? Once we had the formulas down for one line, all we got to do is copy and paste it for all the other lines, right? And then so now what we can see is that in month 11, oh my goodness, under a year, we paid off $22,000 of debt, okay? So 11 months, 22K of debt. So we paid this all off, but the beauty of it is that 1,500 of these expenses will come from these credit cards, okay? So even though we paid them off initially, it's not that we never use the credit cards again. Now these credit cards just are limited towards the 1,500 in expenses, and we never go above that. And so every time we put in our paycheck and then take expenses out, we're going to pay off those credit cards at the last possible moment from our home equity line of credit. Now, if we don't have any debt, we don't even need to use this home equity line of credit anymore. Just use your credit cards, right? Just pay them directly at the last possible moment from your cash savings if we're not in debt payoff mode. But when we are in debt payoff mode, we're going to use our home equity line of credit. Okay. So now we only have one debt left. And let's actually figure out what the mortgage balance is after 11 months. Okay, so if we take a look here, you can see I have a mortgage calculator. Actually, this should be 6.5%, right? So this be 1295.74. So my bad, I did this wrong, 1295.74. So let me go ahead and do this and then just redo this slightly again. I don't know if it's going to make that big of a difference, but this is going to be 2204.26. And then let's go ahead and do that. All right. So it still pays off in the same amount of time, 11 months, 22,000, right? So now we got to focus on this mortgage right here. Let's figure out what the balance is at month 11. And if you didn't know anything about mortgages, so if you have a $205,000 loan at 30 years at 6.5%, you pay 466, almost double, right? Like this is more than 100%. The total interest you pay is more than 100% of the loan amount, 260,000, right? So month 11, only 202,000 has been paid off. So only 3,000 has been paid off. Even though look at this, you're paying all this interest. Oh my gosh, that's insane, right? So let's go ahead and copy and paste this, right? So we're going to copy and paste this. Okay, so now what we're going to do is because we have a higher interest home equity line of credit versus this mortgage, which has a lower interest and a higher balance, right? What you do is you do incremental payoff. So you just move it to chunks of it to that line of credit and use your cash flow to pay it off. So for example, let's say, I mean, we saw in this mortgage calculator here that even after 11 months, it only took out $3,000. So let's say we just wanted to pay off about $5,000 of this. How long would it take us, right? $5,000. So 2002 to 5,000 minus 5,000 would be like 197, right? So this is 1 year. This is almost 2 years to get to 197. But let's go ahead and do this and just move $5,000 to that home equity line of credit. And so I'll just do this. So let me highlight. Okay. And all you're going to do is just add 5000, right? And then you can see it only took 2 months to go there with the strategy without even thinking about it, right? And that's the beautiful part. You don't even think about it. And if you're just following the bank schedule, paying that little bit over time, mostly interest, it would have taken you about like 2 years. Do you see that? Now, luckily, we have a velocity banking calculator provided by Renatus, right? So Renatus is where I originally first learned velocity banking from, and I actually sell their products or educational packages for a commission. So I actually do that. And if you ever purchase an educational package, I think you get this calculator for free. So here's what I'm going to do. This is what I'm going to do. I'm just going to fill in this information here, and it's actually going to auto calculate everything for me. So 205,000, and then right here, which is 202,905.33, that's the current balance. And then if we just put in this information, so 6.5%, it'll do all the calculations for us. It's crazy. All right, so what's the payment amount? 1295.74, 1295.74. And then we're just going to assume that we're only moving $5,000 to that line of credit at a 10% interest rate, and $5,000 is our income. And then our living expenses is going to be everything except the loan we're paying off, so about $1,500. Okay, so now it's going to take us about 5.9 years, 6 years to pay off a 30-year mortgage. Oh my goodness, mind blown, right? So we're going to pay $249,000 of interest, but we only paid 42, which is not bad, right? But here's the thing: even though you're in debt payoff mode, always learn to increase this number as well, right? Try to do that, but not bad. So 5.9 years to pay off a 30-year mortgage. So now what's 11 out of 12 plus 5.9? That's 6.82 years. So 6.8 years debt free. Not bad. And here's the thing: as we were doing this, we were still using all three credit cards just as long as it was equal to 1,500, because we either want those rewards points and to delay the interest as much as possible, right? Delay the interest as much as possible. And here's the thing: if you have a bunch of credit cards and you never use them, bank's going to close them. And the reason why we get credit is for cash flow management, right? And sometimes, you got to be honest. The best credit decision is not the best financial decision, and vice versa, right? So let's say you pay off the mortgage quickly, maybe 6.8 years. It, you know, I can't say this for sure, but it might not look good in your credit report, because it's a risk to the bank to have your debts paid off early, right? Like if I thought I was going to make 100, 200% interest off of you and you pay it off early, then it's like, oh, bollocks. I don't know if that's even a word, right? uh, so again, don't ever be concerned about too much about the credit score, because the credit score is mostly about them evaluating you of if you're a good lendability risk or not. All right, so this is Korean Atlanta mentorship. You can see how easy it was to not only pay off these three credit cards, but also keep using them in the process while doing velocity banking. So the key is that we make sure that our credit cards, when we pay off our general expenses, never surpass this 1,500 a month mark, right? If this is your estimated payoff and you're using this as your estimated cash flow, and actually let me put zero right here. So now at the end, our final cash flow will be 3,500, and if you're not investing this is just going to be accumulated savings over every month, right? And then that's month two, and then 10,500, and oops, so on and so forth. Okay, well, that's it for today. Have a great day, everybody. And also, don't forget, live stream a little bit later today, right here, 6 p.m. Eastern. You got to be a member. Remember, join right here, 99 cents only. And then if you're able to make it, see you all there. If not, even if I'm the only one there, I'm going to have a great time by myself. All right. Have a great day, everybody. We'll speak next time.